Hello, and welcome to the Bull and Bear Invest channel. This is video 1.2 of our Understanding the Stock Market video series. In this video we will cover the basic graphs and sale and purchase orders. Learning to trade can be a daunting time, and some will argue that you can never fully understand how it works, as the stock market partially relies on human behaviour which is unpredictable. However, you can arm yourself with some fundamental information prior to your first investment to ensure the best possible start to making money. Firstly, find a mentor or partner up with a friend. We highly recommend this, as we ourselves would not be in this position at Bull and Bear Invest channel if we hadn't a team together to conduct the research into several companies and identified which would offer the best return. The market is an incredibly volatile and ever-changing environment, and to conduct the research alone is a time-consuming task. Split the responsibility up with another person who has experience of the stock market and discuss your research to verify its validity. Not only that, your mentor may have valuable stock trading experience and would be in a good position to help you should you not fully understand a process. Secondly, follow the stock market. Keep up to date with your investments and other companies that you have on your watch list. The stock market is unpredictable and can change in an instant, so it is best to be armed with the latest developments than to search for the evidence when the time is critical. We advise to subscribe to push notifications from the Vox Markets app, so you are alerted upon the release of each RNS from the companies that you are invested in. It's always a good idea to follow the news headlines. The media has a driving effect on the stock market and can easily provide opportunities to make money if you have done your research and your timing is right. We will cover this in more detail in Module 4 of our Understanding the Stock Market series. This leads us nicely on to point 3, continuous research. To maximise your potential earnings, have a backup plan. Your primary investment may not necessarily always be the best option. Be prepared to sell up and move to new pastures that have promising prospects. We suggest that you should be researching your primary investment thoroughly, as well as at least 2 additional companies to ensure that you are not invested in a non-moving share price. Exploring online courses and seminars is always a good option to develop your knowledge and confidence. Many of these courses are free, but most are not. Some of these courses offer enticing sales pitches which can launch the subscription cost through the roof if you are not careful. Some online services are even fraudulent, so we strongly advise you to continue with caution when deciding which courses to attend. Although these options are available, we believe that the best method of learning is through experience and the support of experienced traders. The majority of other traders are more than happy to provide advice or answer some questions. However silly you may think your question is, just ask it. The chances are, if you have the question, others are thinking it too. By asking it, you may be helping others as well as yourself. Share chat forums are available across the internet, or if you prefer, ask us. We are more than happy to help where we can. Finally, take advantage of those free shares. The majority of trading platforms offer free shares or similar benefits to those who encourage other persons to sign up for their services. These shares may not always be particularly valuable, but it's still cash that can improve your portfolio and help cover the losses that you've made earlier. It is imperative that you know how to read the share price graphs, as this explains the share price movement throughout a period of time. In all graphs, the y-axes represent the share price and the x-axes along the bottom reflect the time period that the share price relates to. This type of graph can be used to show any period, and in this instance we are using it to show the price movement of a share within one day. In this example, the share price closed on the previous day at 0.25p. It is not common to find a share price graph showing the previous day's closing price in this style, as it is often shown with a blue or grey line across the graph. However, for the benefit of this video, we have included it to show the behaviour of the share price upon open. The share price opened today at 0.35p. This is due to sales and market behaviour occurring after the trading day ceased, and in this instance it has worked in our favour. The price remains steady at 0.35p. And note that an increase in share price from the day open is marked with a green line. As the share price drops back to 0.25p, note how the line turns blue. This indicates that the share price is the same as the closing price of the previous trading day. Other graphs may mark this as a grey line. Should the closing price of today match that of the previous day's close price, this phenomenon is called a blue day. As the share price drops to 0.08 pence, notice how the line is now coloured in red. This is because the current share price has dropped lower than the previous close price. This is not always a bad indication, as it can provide a perfect opportunity to purchase more shares, providing that you've done enough research and that you are confident in the company that they will increase the value of the shares you have purchased. As the price increases back above the share price of the previous close, the graph returns to a healthy green colour. If we use the powers available and fast forward to the end of the trading day, we can see that if we had invested on the drop, we would have increased our investment to over 4 times its original value. This would be a 4-bagger or a multi-bagger. Each bag represents your entire original investment. And should this continue and you return 10 times your original investment value, then this would then be considered a 10-bagger. Although this graph was created to illustrate the movement of a share price, these opportunities do exist and you can benefit from them if you undertake enough accurate research into your investments. Another common graph used to explain the stock market activities is the technical graph. This acts similarly to the standard graph shown before, but contains more data in a single bar. For example, the structure of the graph seems to be divided in 2 parts. The top part shows us the share price activity, whilst the lower half shows us the volume of shares traded. The bars in green on the lower half show the volume of shares bought over the volume of shares sold, and those marked in red show the opposite, suggesting larger volume of shares were sold over those that were purchased. To explain the detail of the graph, we will zoom into this section here. Do you see how the bars have lines poking out the top and bottom of them? These contain important information. The top point tells us the share price highest value of that day. The top of the bar shows the closing value of the share that day. The bottom of the bar shows the open price of the share that day, and the lowest point represents the day's lowest share price value. As the closing price was higher than the open price, this bar is coloured in green. On this example, notice how there is no point at the top of the bar. This is because the highest share price value of that day was the same as the open value. This time, the lowest point of the bar indicates the closing share price of the share, and the lowest point of the spike is the lowest value during the trading day. As the share price finished lower than the open price of that day, this bar is coloured in red. The bigger the bar, the bigger the difference in price, and likewise the longer the spikes, the more volatile the share is considered to be. Now we will cover the most common methods of buying and selling shares and their key functions. The basic order or market order is the standard method of purchasing shares. This instructs the broker to buy the shares at the best possible price at the time of submitting your order. The limit order allows you to control the price at which you wish to purchase your shares. By setting the value, it will remain dormant until the share price reaches or is lower than the value of which you want to purchase the shares at. If the criteria are met, then the order is processed as a market order. If the criteria are not met, then the order will not be processed. Stamp duty is an important tax to remember. When purchasing UK shares, you will pay 0.5% of the value of the trade as stamp duty. This is also known as stamp duty reserve tax. Most platforms calculate and pay this on your behalf, but you should remain aware of your circumstances where this does not happen, and you may need to calculate this for yourself. The basic order or market order is the standard method of selling shares. It works on the exact same principles as buying shares and instructs the broker to sell the shares at the best possible price at the time of submitting your order. The limit order allows you to control the price at which you wish to sell your shares. By setting the value, the sale order will remain dormant until the share price reaches or is greater than the value of which you want to sell the shares at. If the criteria are met, then the order is processed as a market order, and if the criteria is not met, then the order will not be processed. One of the more valuable sell orders available is called a stop loss. Similar to the limit order, it allows you to set the value lower than the current share price. And if the share price meets or falls below the share price submitted, the order is then processed. Theoretically, this allows you to sell your shares before they lose any further value. If the criteria is not met, then the order is not processed. A common misconception is that you have lost your money when the share price of your investment is lower than the price at which you've purchased it. Technically, this is correct, as the negative value is evident. However, your investment is not lost until you sell your stock lower than the price of which you've purchased it. Your volume of shares has not changed, and these still have the potential to increase with value over the time. Another key note is when selling UK stocks, you should always ensure that you sell after making a profit of a minimum of 0.5% to return the cost of stamp duty that you would have paid upon purchase. Otherwise, you're still losing money despite your figures showing that you've made a profit. We hope that you found the content of this video useful. Be sure to subscribe to our YouTube channel so you don't miss another video. You can also find us on all major social media platforms by searching the Bull and Bear Invest channel. Bull and Bear Invest channel take great care to ensure the accurate information is provided in all of our videos. Bull and Bear Invest channel and the persons thereof are not liable for any financial losses sustained during investing.